Listen, I need you to stop scrolling right now because what I am about to reveal will completely change how you understand what just happened in the silver market. In the next few minutes, you're going to discover why thousands of retail investors just walked straight into one of the biggest traps of the year, and more importantly, how you can avoid becoming the next victim. This isn't about conspiracy theories or wild predictions. This is about cold, hard market mechanics that separate the winners from the losers. And if you stay with me until the end, you'll understand exactly what the smart money is doing right now while everyone else is panicking. Before we go any further, do me a favor. Hit that subscribe button and turn on notifications for Dark Economy. I'm serious about this. The information you're about to get is worth thousands of dollars in avoided losses. And if you don't want to miss the next critical market move, you need to be part of this community. Click subscribe right now. I'll wait. Good. Now let's dive into what really happened today. If you bought silver this morning because you saw some exciting headlines or watched a few hype videos, I need to be brutally honest with you. You just became exit liquidity for some of the most sophisticated players in the financial world. And I know that's harsh to hear, but understanding this reality is the first step to never making this mistake again. Let me explain exactly what went down and why it matters for your financial future. Yesterday, Bank of America, one of the largest and most influential financial institutions on the planet, published a research report that sent shockwaves through the precious metals community. They predicted that silver could eventually reach $39 per ounce over the long term. Now, when a major bank like this makes a bullish call on silver, especially when they've been bearish for years, people pay attention. Retail investors across social media platforms saw this number and immediately jumped to a dangerous conclusion. They assumed the price was about to explode immediately. What happened next was completely predictable if you understand market psychology. Retail traders rushed into the market like a stampede, pushing silver prices up to $82.75 in a single morning session. The excitement was palpable. Comment sections were filled with rocket emojis and predictions of silver going to $100 or more. People were convinced they were witnessing history in the making, that this was their moment to get rich quick. But here's where the story takes a dark turn. The moment that euphoria reached its absolute peak, something changed. A massive wave of selling pressure hit the market like a freight train. The price didn't just pause or consolidate, it collapsed. Within hours, silver had dropped to $78.54. Anyone who bought near that morning high was already sitting on losses exceeding 5%, and that's just in a matter of hours. This is what traders call a classic sell the news event, and it happens over and over again in financial markets because human psychology never changes. Let me break down the mechanics of what really happened here, because once you understand this, you'll start seeing these patterns everywhere. Imagine you're a massive hedge fund or a sophisticated trading desk at a major bank. You've been accumulating millions of ounces of silver over the past few months when the price was hovering around $60. Now the price has climbed to $82 and you're sitting on enormous paper profits. But here's the problem. If you try to sell millions of ounces all at once, you'll crash the market before you can exit your position. You need buyers, lots and lots of buyers, all stepping up to take your inventory off your hands. This is where the magic of market manipulation, or let's call it sophisticated marketing, comes into play. A bullish research report from a credible institution like Bank of America creates exactly what you need. It generates a flood of retail buyers who are driven by emotion, by fear of missing out, by dreams of quick profits. These retail traders see the headline, they see the price starting to move up, and they panic into the market. They're not thinking about risk management or position sizing or market structure. They're thinking about getting rich. And this is when the smart money makes their move. As all these retail buyers are rushing in, pushing the price higher and higher, the institutions are quietly selling into that excitement. Every time a retail trader hits the buy button near $82 or $83, there's an institution on the other side hitting the sell button. The spike to $83 this morning wasn't random, chance, or natural market movement. It was perfectly orchestrated. The banks needed that spike to create enough liquidity to exit their positions profitably. Once the institutions had offloaded enough of their inventory, there was no longer any buying pressure to support those elevated prices. And this is why the crash happened so quickly. It's not that silver suddenly became less valuable or that the fundamentals changed in a few hours. It's simply that the artificial buying pressure created by retail euphoria had been exhausted, and now reality was setting in. The traders who survived this event are the ones who understood this game. The ones who lost money are the ones who traded on emotion instead of logic. Now, let's talk about the technical aspects of what we're seeing in the silver chart, because this tells us a lot about what might happen next. Silver has formed what technical analysts call a double top pattern. If you're not familiar with chart patterns, a double top looks like the letter M. It forms when price reaches a certain level, gets rejected, pulls back, then tries again to break that level and gets rejected again. This pattern is significant because it shows that sellers are aggressively defending a specific price point. In silver's case, that resistance level is around $83. Every single time the price has approached that ceiling, it's been smashed back down. This isn't coincidence. There are massive sell orders waiting at that level, and until those orders are absorbed or removed, silver is going to have a very hard time breaking through. The failed attempt to break 82.75 this morning is just the latest example of this dynamic playing out in real time. But here's what makes this situation even more interesting. Gold, which usually moves in tandem with silver, also experienced selling pressure today. Gold pulled back to around $4,453, down about $32 on the day. This tells us we're seeing coordinated selling across precious metals, not just isolated selling in silver. And when you dig into the reasons behind this broader selling pressure, you find that rising bond yields are playing a major role. When bond yields go up, it makes bonds more attractive relative to non-yielding assets like gold and silver. Institutional investors start reallocating capital, moving some money out of precious metals and into bonds to capture those higher yields. Now here's the critical thing to understand about the gold-silver relationship. Silver is significantly more volatile than gold. On average, silver moves about 3 times harder than gold in both directions. So when gold drops a little bit, silver drops a lot. When gold rises moderately, silver can absolutely explode to the upside. Think of it this way. Gold is like the parent, stable and measured in its movements. Silver is like the teenager, emotional and prone to dramatic mood swings. The teenager might throw a tantrum and overreact to situations, but the parent remains steady. This is why silver can be both incredibly profitable and incredibly frustrating to trade. The volatility creates opportunity, but it also creates risk. And managing that risk is what separates successful traders from those who blow up their accounts. Now, I want to address something really important about the Bank of America report because there's a huge misunderstanding that is causing people to make bad decisions. When Bank of America talks about silver potentially reaching $300, they're not saying this will happen next week or next month. They're talking about a long-term thesis that might play out over the next several years, potentially by 2026 or 2027. This is a strategic forecast based on supply and demand fundamentals, not a short-term trading call. But retail traders don't read these reports carefully. They see the headline, they see the big number, and they assume it means immediate gains are coming. This mismatch between the time horizon of the forecast and the time horizon of the trader is exactly why so many people get caught in these violent price swings. Day traders are trying to make money in hours or days, but they're trading based on forecasts that are meant to play out over years. That's a recipe for disaster, and it's exactly what we saw today. The $2 drop we witnessed today is essentially noise when you zoom out and look at the bigger picture. If silver really is heading toward much higher prices over the next few years, then a pullback from 82 to 78 is just a minor correction in a much larger bull market. But if you're over-leveraged, if you bought at the top with money you can't afford to lose, if you're trading on emotion instead of having a plan, then that $2 drop feels catastrophic. This is why position sizing and risk management matter so much. Let's go deeper into what the Bank of America report actually says, because understanding their reasoning is crucial. Bank of America has historically been bearish on silver for years. They've consistently predicted lower prices or sideways action. So when an institution like this completely reverses their stance and turns bullish, that's a significant signal. In their latest research, they admitted 3 critical truths that completely validate the bull case for silver. First, they acknowledge that mining supply is severely constrained. You can't just flip a switch and produce more silver. Mining projects take years to develop, require massive capital investment, and face increasing environmental and regulatory hurdles. The existing mines are depleting, and new discoveries aren't keeping pace with demand. This creates a structural supply deficit that gets worse over time. Second, they recognize that demand from the solar industry is unstoppable. Silver is a critical component in solar panels, and as the world transitions toward renewable energy, solar installations are exploding globally. China alone is installing solar capacity at a pace that was unimaginable just a few years ago. This industrial demand for silver is not speculative. It's real, it's growing, and it's not going away. Third, they confirmed that silver's price is directly tied to gold's performance, but with amplified moves. When gold enters a bull market, silver typically outperforms gold by a significant margin. We've seen this pattern play out multiple times throughout history, and there's no reason to think this time will be different. Gold is currently in a strong uptrend, sitting near all-time highs, and if gold continues higher, silver should follow with even bigger percentage gains. These 3 factors, supply constraints, unstoppable industrial demand, and correlation with gold, form the foundation of the bullish thesis for silver. And when a major bank like Bank of America validates this thesis after years of skepticism, it changes the institutional narrative. Suddenly, it becomes acceptable for pension funds, insurance companies, and other large allocators to add silver exposure to their portfolios. This brings us to a critical question. Why does timing matter so much in this situation? Because the big institutional players don't make investment decisions based on YouTube videos or Twitter threads. They make decisions based on research reports from credible institutions. When Bank of America publishes bullish guidance on silver, it provides cover for portfolio managers who might have been hesitant to add precious metals exposure. Now they can point to the research and say, this is why we're allocating capital to silver. It's not speculation. It's based on fundamental analysis from a respected source. The $78 level that silver bounced from today isn't just a random number. It's where institutions are likely accumulating positions quietly. Think about it from their perspective. They want to buy silver, but they don't want to chase prices higher. They're patient. They wait for moments of panic, for days when retail traders are selling in fear, and that's when they step in and buy. Today's flush created exactly that opportunity. And I would bet that institutional buying was heavy in the $78 to $79 range. Let's talk about the mechanics of today as price action in more detail, because understanding this will help you recognize similar setups in the future. The spike to $83 was driven by a combination of retail excitement and some early institutional front-running. Some smart money players saw the Bank of America report before it was widely distributed and started buying in anticipation of the retail rush. This pushed prices higher in the early morning hours, but the sell-off that followed wasn't panic selling from weak hands. It was deliberate profit-taking from traders who understood the game. If you look at the volume during the drop, it was elevated but not extreme. This is important. Extreme volume during a decline often signals capitulation, where everyone is rushing for the exits at once. But moderate to high volume during a decline, especially when price finds support and bounces, suggests that buyers are actually stepping in at lower levels. Notice how silver bounced multiple times at $78.40. That's not coincidence. There were buy orders stacked at that level, and every time price dipped down there, buyers absorbed the selling pressure and pushed price back up. This is what accumulation looks like in real time. It's messy, it's volatile, but it's a sign that smart money is building positions. This calm period after the storm is often the setup for the next big move higher. Now let's identify the key support and resistance levels that you need to watch going forward. The immediate line in the sand is $78. As long as silver holds above 78, the short-term trend remains intact, and there is a good chance we'll see another attempt to break through $83. If 78 breaks, the next major support level is $75. That level was resistance throughout December, and in technical analysis, old resistance often becomes new support when price breaks through. Here's what you need to focus on. The weekly close this Friday is far more important than any intraday price movement. If silver closes the week above $75, that confirms the breakout is legitimate and the overall trend is still bullish. A weekly close below 75, however, would be a warning sign that the move has failed and we could see a deeper correction back toward $70 or even lower. Watching the weekly chart takes the emotion out of trading and helps you focus on what actually matters. Technical indicators are also telling an important story right now. The Relative Strength Index, or RSI, which measures momentum, was above 80 yesterday. That's a sign of extreme overbought conditions, which often precedes a pullback. Today, the RSI has cooled back down into the low 60s. This is healthy. It means the market has reset without destroying the uptrend. The rally has paused to catch its breath, and this consolidation phase is actually setting the stage for the next leg higher. Think about it like running a marathon. You can't sprint the entire race. You need to pace yourself, take water breaks, and let your body recover before pushing hard again. Markets work the same way. Consolidation periods are boring, but they're necessary and sustainable. They shake out the weak hands, they reset the technical indicators, and they create a foundation for the next move. Sharp vertical rallies that never pause almost always end in equally sharp corrections. One interesting dynamic to watch is the gold to silver ratio. Today, this ratio widened slightly, meaning silver became cheaper relative to gold. When this happens, it naturally attracts value buyers who look for opportunities when silver is undervalued compared to gold. There are also sophisticated algorithms that monitor this ratio and automatically trade to keep it within a certain range. When silver gets too cheap relative to gold, these algorithms buy silver and sell gold to rebalance. This creates a natural floor under silver prices and provides support during pullbacks. Here's something crucial I need you to understand. Do not trust the mainstream financial media headlines tomorrow. They're going to scream things like silver crashes or bubble bursts or retail traders lose millions. The media loves red candles and panic because fear generates clicks and views. They have no incentive to explain the actual mechanics behind the moves. They don't talk about institutional accumulation or market structure or long-term fundamentals. They just want to scare you into clicking and sharing. But you're different. You're watching this video, which means you're taking the time to understand what's really happening beneath the surface. This knowledge puts you ahead of 95% of market participants. You understand that today's flush was tactical, not strategic. It was a transfer of silver from weak hands who bought at the top to strong hands who bought the dip. This is how wealth is transferred in financial markets. And now you know which side of that transfer you want to be on. Let me share what I believe is the most important lesson from today's shakeout. Sometimes in trading and investing, the best move is no move at all. I know that sounds boring and counterintuitive, especially in a market as exciting as silver right now, but hear me out. When you constantly try to trade around every little price swing, you end up getting whipsawed. You sell, then the market goes up. You buy, then the market goes down. You pay fees and spread on every trade, and your capital gets slowly ground away. But if you already own silver, if you bought it at $60 or $70 or even $75, you're already in the position. You're not inside the casino getting tossed around by every spin of the roulette wheel. You're outside the casino watching the chaos from a position of strength. Your only job now is to hold through the volatility and wait for the thesis to play out. Patience is your biggest advantage in this situation, and it costs you nothing except the discipline to sit still. For those of you who missed the initial breakout earlier this year and have been waiting for a pullback, today's dip is essentially a second chance. Silver in the $75 to $78 range is what I would call a gift zone. You're buying a breakout asset at a discount, not at a premium. You're entering after a healthy correction that has reset the technical indicators and shaken out the weak hands. This is a much better entry than buying into euphoria at $82 with everyone else piling in. Stop hoping for silver to drop back to $60. That floor is gone. The market has moved on. The fundamentals have changed. And institutional money is flowing in. If you keep waiting for the perfect entry that matches prices from months ago, you're going to miss the entire move. Recognize this opportunity for what it is. It's a low-risk entry point into a market that is controlled by institutions, but still undervalued relative to its long-term potential. The Bank of America report may have triggered panic and volatility for day traders today, but the core message of the report remains bullish. They used the retail excitement to reposition their portfolios, to take profits on old positions, and potentially start building new ones at better prices. But the fundamental math behind silver's valuation hasn't changed at all. The supply deficit is still real. The solar demand is still growing. The monetary fundamentals that support precious metals are still intact. If you're patient and you focus on the long-term picture instead of day-to-day noise, the $300 target isn't some wild fantasy. It's a roadmap based on supply and demand realities. The trap was sprung today. Weak hands got shaken out. Emotional traders took losses, but the strong hands, the patient investors who understand the game, they're still holding. They might have even added to their positions during the dip. This is the difference between trading and investing, between reacting and planning, between hoping and knowing. As we move forward, focus on the weekly close this Friday. That's your North Star right now. A close above $75 confirms the breakout and suggests higher prices are coming. A close below 75 is a warning that more downside might be ahead and you need to reassess your risk. Either way, you now understand the difference between temporary panic and long-term opportunity. You can see through the noise and identify what actually matters. Silver is changing hands right now. Weak hands are flushed out. Strong hands are accumulating. This is the natural rhythm of bull markets. They don't go straight up. They climb, they correct, they consolidate, and then they climb again. Each correction shakes out more weak hands and leaves the market in the hands of committed investors who aren't going to panic at the first sign of volatility. This creates a stronger foundation for the next leg up. Let me tell you something that goes beyond just prices and charts. This is about the system itself. The fact that Bank of America, an institution that was suppressing silver prices through bearish research for years, has now flipped and turned bullish, that's enormously significant. It means the institutional narrative has changed. Pension funds are positioning quietly in the background. The public perception is slowly catching up to what insiders have known for a while. Silver is undervalued, it's volatile, but it's fundamentally bulletproof. If you're holding silver right now, hold the line. Watch that $75 support level. Remember why you started stacking in the first place. It wasn't to make a quick buck on a day trade, it was because you understood the long-term fundamentals. You understood that fiat currencies are being debased, that governments are printing money like there's no tomorrow, that real assets like silver are going to preserve purchasing power over time. Now, I want to talk about something that a lot of people don't consider. The psychological battle that happens during these corrections. When you see your portfolio drop 5% in a day, your brain starts screaming at you to do something. Your fight or flight instinct kicks in. You feel an overwhelming urge to sell, to stop the pain, to get out before it gets worse. This is completely normal. This is how human psychology works. But this is also exactly why most people lose money in markets. The winners are the ones who can override that instinct. They're the ones who can look at the drop objectively, check if the fundamentals have changed, and if the fundamentals are still intact, they hold or even buy more. This is incredibly hard to do. It goes against every natural instinct. But this is also why the rewards can be so great. You're getting paid for doing something that most people can't do emotionally. Think about every major bull market in history. Gold from 2000 to 2011. Bitcoin from 2015 to 2017, and again from 2020 to 2021. Tesla stock over the past decade. Every single one of these massive winners experienced brutal corrections along the way. 30% drops, 50% crashes, periods where it looked like the whole thing was falling apart. And in every case, the people who held through those corrections and stayed focused on the long-term thesis made life-changing returns. The people who panicked and sold during the corrections missed out. I'm not saying silver is guaranteed to go to $300 or that there won't be more volatility ahead. Markets are unpredictable and anything can happen. What I am saying is that if you believe in the fundamental thesis, if you have done your research and you're convinced that silver is undervalued relative to its long-term potential, then temporary price swings shouldn't change your strategy. They're just noise. They're opportunities to add to positions, not reasons to abandon them. Another thing worth discussing is position sizing and risk management. If today's drop caused you serious stress or panic, that's a sign that you might have too much capital allocated to silver. A good rule of thumb is that you should never invest more in any single asset than you can afford to lose without it affecting your quality of life. If a 20% drop in silver would devastate you financially or emotionally, you need to reduce your position size. The goal is to have enough exposure that you benefit significantly if silver does go on a major run, but not so much exposure that volatility keeps you up at night. When you're properly positioned, you can watch these corrections with calm detachment. You can even get excited about them because there are opportunities to buy more at better prices. But if you're over-leveraged, every red candle feels like a catastrophe. Let me also address the people who are thinking about selling here to try to buy back lower. This is an incredibly tempting thought process. You're sitting on gains, you see the price pulling back, and you think if I sell now and buy back at $75 or $70, I'll have more silver for the same amount of money. In theory, this makes sense. In practice, it's extremely difficult to execute successfully. First, you have to time the sale correctly. If you sell at 79 and the price bounces to 85 without coming back down, you've just locked in your exit and missed the next leg up. Second, you have to have the discipline to actually buy back in when price does drop. Most people who sell don't buy back. They either get scared that it will drop further or they get distracted and miss the opportunity. Third, you're paying taxes on your gains if you're in a taxable account, which eats into your capital. The simple truth is that for most people, the highest probability strategy is to buy, hold, and add on significant dips. Trying to trade in and out might work occasionally, but over time, it usually results in having less silver, not more. There's a reason why the wealthiest investors in the world, people like Warren Buffett, talk constantly about the power of long-term holding. It's not because they're too lazy to trade. It's because they've learned that trading in and out usually destroys returns. Now let's talk about what could potentially go wrong with the silver thesis. I always think it's important to consider the bear case, even when you're bullish on something. What are the risks? What could cause silver to go down instead of up? Understanding these risks helps you make better decisions and avoid being blindsided. One risk is a global economic recession that's severe enough to crush industrial demand for silver. If factories shut down, if solar panel installation grinds to a halt, demand for silver could drop significantly. However, silver is also a monetary metal and a safe haven asset, so it might actually rise during a recession as investors flee to precious metals. But it's worth acknowledging that a demand shock is a potential risk. Another risk is aggressive interest rate hikes from central banks. If the Federal Reserve decides to jack rates up to 15 or 20% to combat inflation, that would make bonds extremely attractive and could pull money out of precious metals. However, given the amount of debt in the system, extremely high interest rates would likely crash the economy and force central banks to pivot back to low rates, which would ultimately be bullish for silver. The third risk is new mining supply coming online faster than expected. If there are major new silver discoveries or if mining technology advances dramatically, the supply constraints could ease. But historically, mining supply responds very slowly to price signals, and new projects take many years to develop. So while this is theoretically possible, it's not likely in the near term. The point is, no investment is risk-free. Silver could go down. It could go sideways for years. The $300 target might never materialize. But when you weigh the probabilities and look at the risk-reward ratio, silver at current levels looks attractive to many investors, myself included. The potential upside significantly outweighs the potential downside, especially if you're buying with a long-term perspective. Before we wrap up, I want to emphasize the importance of continuing education. Markets are constantly evolving. New information comes out every day. The players change, the tactics change, the fundamentals shift over time. If you're serious about succeeding in markets, you can't just learn something once and assume that knowledge will be sufficient forever. You need to constantly update your understanding, challenge your assumptions, and adapt to new realities. This is exactly why I created Dark Economy. This channel exists to cut through the noise, to give you real analysis based on market mechanics instead of hype, to help you understand what's really happening so you can make informed decisions. But I can only do that if you're part of the community. Hit that subscribe button if you haven't already. Turn on notifications so you never miss a critical update. Leave a comment below with your thoughts on silver and what you're planning to do after today's action. And here's something really important. Share this video with anyone you know who's interested in silver or precious metals. There are so many people out there who are getting caught in these traps because they don't understand the mechanics. They're trading on emotion, following the hype, and losing money as a result. If you found value in this analysis, if you learned something that could save you from making a costly mistake, share that value with others. That's how we build a stronger, smarter community of investors. Knowledge is power in financial markets. The more people who understand how the game is played, the harder it becomes for institutions to manipulate prices and trap retail traders. By sharing this information, you're not just helping your friends and family. You're contributing to a more informed market where manipulation becomes more difficult. That benefits everyone except the manipulators. As we close out this video, let me leave you with a few final thoughts. But when you understand the mechanics, when you know how institutions operate, when you can separate signal from noise, today's volatility becomes less scary and more understandable. The trap was sprung. Weak hands sold, strong hands held or bought. This is the natural rhythm of bull markets. The weekly close this Friday is critical. Above 75 confirms the breakout. Below 75 signals potential trouble. Watch that level, stay calm, stick to your plan. If you're a long-term investor who believes in the fundamentals, use dips as opportunities to add to positions. If you're a trader, respect the volatility and manage your risk carefully. Remember why you're in silver. It's not just about making a quick profit. It's about preserving wealth in an era of currency debasement. It's about owning a real asset that has value, regardless of what central banks and governments do. It's about positioning yourself for a potential major move higher based on supply-demand fundamentals that are difficult to dispute. Stay alert, stay patient, and most importantly, stay educated. The markets will continue to be volatile. There will be more days like today. But if you understand what's happening and why, you'll be able to navigate that volatility successfully. Thank you for watching Dark Economy. Make sure you're subscribed, hit that notification bell, comment below, and share this video. I'll see you in the next one.